Okay, it's 12 o'clock UK time. Welcome everyone to today's FS Club webinar, which is going to look at emerging markets, turmoil or opportunity. I'm James Pitcher and I head up the Financial Services, or FS Club, the premier networking organisation for those involved or interested in all things financial services. Within ZN's Long Finance arm, we've been running the FS Club now since the 1st of January last year, but it was actually started by Chris Skinner, our co-chairman, in 2004. Professor Michael Manelli, Executive Chairman of ZN, is the other co-chairman. So for today, for the next half an hour or so, after just quite literally a couple of minutes from me, I'm delighted to say we're going to hear from two excellent speakers who are truly embroiled in emerging markets. Firstly, we'll hear from Eric Anderson, Managing Partner and Head of Investment Solutions at Milltrust International. Eric will give us a general overview of equities in emerging markets. Then we'll hear from Joyce Poon from Gavical, who will offer a deeper dive into a specific market from a fixed income perspective. There will be an opportunity for you to ask questions, which you can do by typing them into the panel at the top right-hand side of your screen. So at the Financial Services Club, the benefits we bring to our members and audience fall under three important headings: news, events, and partnerships. For news, you can sign up to receive our daily FS News email, which will also provide access to Chris Skinner's daily blog. Chris is often insightful, thought-provoking, sometimes controversial and entertaining. You can also choose to receive customized news bulletins. We have over 200 categories, including asset management, sustainable cities, computer science, COVID-19, of course, and many more. These are AI-generated summaries taken from over 40,000 sources and provide you with key points from relevant articles around the globe. This is an example on the screen of what an emerging market one will look like. That does look like. Signing up to our daily news email will automatically register you to receive invites to our significant program of events. Ordinarily, these would be fortnightly networking events typically held in London, but obviously we've had to adapt quickly. And we now have an extensive program of webinars, now almost running at nearly one a day. So do keep an eye on the website for these and other webinars that we have in the pipeline. Finally, we believe in partnerships and are keen to build out our community. We have nearly 200 members, over 6,000 invitees to those events, and a global community of over 57,000 financial services professionals. You can also subscribe to our growing list of special interest groups, which include an anti-money laundering task force, financial centres, city focuses, and employee share ownership, for example. Or you can earn continual professional development, or CPD, points via our relationship with the CISI, and we will be adding more organisations in due course also. So just before I hand over to Eric, my involvement in emerging markets was back in the 90s and the noughties, where I was establishing agent bank relationships on behalf of a global investment bank. In those days, I guess the opportunities for us at that time were how many countries you could add to your portfolio, and then the turmoil was often the fact that those countries often didn't have the capital market infrastructure that could cope with the subsequent inward foreign investment. So perhaps, I'm guessing, different opportunities and causes of turmoil nowadays. And with that in mind, and without any further ado, I'm going to hand over to Eric.
Thank you, James. Thank you for the introduction. If I can ask you to move over a couple slides to the approach slide. If I can take a couple minutes now, or just maybe a minute, to quick background on Milltrust and our approach to EM. Milltrust is a London and Singapore-based asset manager with a core focus on delivering global emerging market investment solutions to investors. Our approach is to identify leading locally based investment managers in each of the key countries and regions across the emerging markets who are specialists in putting together high conviction equity portfolios of high quality companies. Each specialist team manages their country regional portfolio within a sub-fund on our EM platform. These sub-funds form the basis of our global EM strategy. The amount we allocate to each country regional sub-fund is a function of our asset allocation models, which helps identify the more favorable environment within the EM universe. So that's the context of our strategy, which we've been doing since 2012. Next slide, please. Turmoil or opportunity? Well, we have certainly had our fair share of turmoil in EM these last few years, with Argentina's bond crisis, Donald Trump's Iran shock, the US-China trade war, and now this pandemic. The question I really want to help answer is, what is it going to take to turn the corner for EM? When does the turmoil turn into an opportunity? In our view, there are three main milestones to look out for as the world recovers from this pandemic. Number one, no significant second wave of cases in China. A peak in Chinese coronavirus cases seems to have already happened, as you can see from the graph on the top left. There have not been any domestic newly confirmed cases for most of the last few weeks. As for the imported ones from overseas travelers, the numbers have been fairly small. Milestone number two, Chinese companies experience a full restart, returning to 100% capacity within the next quarter. If you look at the chart on the top right, this is the China Economy Recovery Index, a Bloomberg economics indicator. This is a high-frequency indicator that gauges activity from both the production and demand sides. It's updated daily with a 2-day lag. The chart is showing us that activity has continued to pick up, and we are close to 90% now. Unsurprisingly, the first two milestones relate to China stabilizing, and this is a must. Besides this data, the good news is that our specialists on the ground China team are already seeing early signs of recovery and continue to hold the view that consumption in China is very likely to follow a sharp V-shaped trajectory, which actually is in stark contrast to consensus expectations of a slow and gradual recovery. After 6 weeks of lockdown, the Chinese are largely back to their everyday lives. Most of the provinces have announced reopening of schools, which could drive a back-to-school consumption burst. In Shanghai, where our investment team is based, all public facilities have reopened. There is a lot more traffic on the streets, and the provincial government has publicly encouraged people to take their masks off. Our channel checks with leading retail space operators in Shanghai and neighboring cities suggest that by the last week of March, most of the shopping complexes have seen retail sales and foot traffic back to 90–95% of the level during the same period last year. Data from TomTom, which is a location technology company, suggests that rush hour traffic in some big Chinese cities has recently reached levels comparable to the average across 2019. All of this data supports our view of a sharp V-shaped recovery for the Chinese consumer space. Anecdotally, many companies have been guiding to expect things to be back to normal by May or June. The numbers are also ticking up. The China's official manufacturing PMI rebounded from 35.7 in February to 52 in March, as you can see from the graph on the bottom left. If China can return to work without experiencing a major resurgence in cases, that will bode well for the state of the rest of the world in a few months' time and will likely be positive for emerging market equities. The third milestone relates to avoiding a liquidity crisis. Liquidity risks in emerging markets have spooked investors since the start of the pandemic, and this is where the central banks and the IMF have to step in. It is about building a bridge to the point where the recovery starts. First of all, and as we have all seen, both rich and poor countries outside of the US are now grappling with the preeminence of the dollar as the ultimate international settlement currency. Foreign dollar debt amounts to about $12 trillion, and we know that in periods of crisis, companies and countries struggle to find enough dollar liquidity. Since the start of this pandemic, the dollar funding squeeze has been vicious. If you look at the graph on the bottom right, you can see the significant depreciation versus the dollar in some of the main EM currencies. Some $62 billion was yanked out of EM in the first quarter in a global dash for cash by investors. Now, this is twice the size of outflows at the peak of the world financial crisis. The Federal Reserve is trying to manage this by providing dollars to other major central banks through swap lines, including with Brazil, South Korea, and Mexico, and this should help ease the funding squeeze and pave the way to provide some stability. As of last week, the Fed now also allows them to exchange their treasury holdings for dollars. So the central banks of the world and the IMF, so how the central banks of the world and the IMF manages this liquidity will be an important feature of this crisis. The bottom line, this is an important one, is that EM represents 60% of the world economy on the basis of purchasing power. A slowdown in developing countries is a slowdown for the planet. And as we get more visibility on the fallout and the global shutdown gradually eases, safe haven demand for dollars is likely to recede, which will help ease these liquidity risks. Now I want to shift my presentation to where you can find opportunities in EM. It is such a huge asset class, but the way to make money is simple. Pick the right countries to get exposure to and pick the right stocks. That's the double alpha of EM. So perfect, thank you. First of all, picking the right country. It goes without saying that resilience that the resilience and subsequent recovery between countries in EM will vary and can vary significantly. Putting it very simplistically, within EM you have your commodity producers like Russia, Saudi Arabia, your exporters like Korea, Taiwan, and your domestic plays like China and India. Each bucket, if you will, has its own set of drivers and vulnerabilities. Country analysis is going to be critical. In 2008, Warren Buffett famously said, when the tide goes out, you see who's wearing a bathing suit and who isn't. In 2008, he was talking about banks for the most part, but today the coronavirus is like that receding tide, and it exposes any countries that are well governed and which ones are not. It exposes which countries have strong health systems and which ones do not. It exposes which countries and communities have high degrees of social trust and can work together in a crisis, and which ones do not. What we're living through is the mother of all stress tests. I can show you a vast amount of data, but if you look at the credit default swaps on the graph on the left side of the slide, a key measure of credit risk, there's been varying degrees of change. Some have jumped significantly in recent weeks, tripling or quadrupling in some cases. Widening credit spreads point to increasing problems at overly leveraged countries now facing challenges from deteriorating fiscal budgets as a result of the impact from the coronavirus. It's not a surprise to see spreads have risen the most in regions such as Sub-Saharan Africa and Latin America, where public finances generally are a lot weaker than in places like emerging Asia and Central Eastern Europe. Countries with significant levels of hard currency debt, such as Turkey and South Africa, also face refinancing risk, given the difficulty in rolling over bonds under current conditions. On the positive side, South Korea and China have had very little movement. South Korea seemed to have contained its outbreak quickly and efficiently, a fact widely attributed to abundant testing. They used a mix of innovative technology-enabled tracking systems and transparent information sharing to help prevent the worst-case scenario. They have had no lockdowns, no roadblocks, no restrictions on movements, no panic, no queues, no stockpiling. Meanwhile, China implemented strict isolation protocols that seemed draconian early in the outbreak, but that many Western economies eventually mimicked. Perhaps, and this is debatable, one of the biggest changes to come out of this might be the perception of relative risks of EM versus developed markets. Some of these EM governments have showed us that they know how to manage a crisis, as they've been doing it on a regular basis in the past. It begs the question as to how we define a developed economy. Historically, it's been on average wealth level. How about preparedness to protect its citizens in periods of crisis? I think this will be one of the many interesting points that we'll be exploring in the world when the world moves on post-COVID. Another factor that I've highlighted here on the graph on the right is the debt to GDP ratios. A lot of these EMs are looking fine and certainly in a stronger place to deal with this crisis than at any previous time. This also means that their scope for fiscal easing, an important tool in this environment, is much more. Korea's public debt to GDP is 40%, Taiwan is 30%, even Indonesia, a country that has historically been cyclical because of balance sheet crises, has got 30%, Russia 15%. The bottom line is that there will be some clear winners and some clear losers within the EM country universe, as the resilience and subsequent recovery between EM countries will vary significantly. The way to manage this is by actively tilting your exposure towards the countries' economies that are more favorable. I am running out of time, but I need a few more minutes to wrap up by talking about the opportunities at the stock level. Next slide, please. Let's start by stating the obvious. EM equities are cheap, right? Even Indian equities, the perennial expensive markets, have come down to the historical average. If you look at the graph on the top left, stocks across the developing world now trade an average of just under 8 times profits on a cyclically adjusted 10 years basis. This is over 10 years, which is below levels during the financial crisis, and a 65% discount to the same ratio for the US stock market. This is a record. I can say without hesitation that from a valuation perspective, this is the best buying opportunity in decades. If you follow markets, you will have noticed that we've seen the markets rally starting from the third week of March. Some of our investors have expressed a fear of missing out. But to be clear, the near 30% rally in the US and some developed markets has not been widespread. US equities may have rallied following the unprecedented stimulus packages in the US, but EM have lagged and are still in oversold conditions. And you can see this on the graph on the top right. Having said all of that, and while valuations have come down considerably, valuations alone are not enough. Companies will go bust, dividends will be slashed, and so forth. Yet surviving companies will face less competition and a clearer runway to take off in the aftermath of the crisis. So you want to own those companies. The fundamentals offer an incredible opportunity to exploit, especially for the liquid, high-quality emerging market plays. We probably have got maybe 3 more months of delicately walking across crevices now, but we think that is a small risk for the reward that could be huge. When evaluating companies, a key focus is on sustainability of earnings and future cash flows. But in our view, investing in companies with strong balance sheets becomes a more important factor in this environment. And the good news is that EM is a lot of them. As we know, companies in EM have gone through their fair share of crises. A lot of corporates end up holding more cash, perhaps than maybe they should. If you look at the top 100 companies, ex-financials listed in Hong Kong, China, so on the bottom left here, half of them have net cash on the balance sheet compared to the US equivalent, where there's only 18% holding net cash balances, or 21% for the UK. It's 40% in Korea and nearly 60% in Taiwan that have net cash positions on the balance sheet. This gives you a sense of the landscape of companies and highlights that there's some strong balance sheets in these regions. We have also seen a number of stimulus packages ring-fenced for domestic consumption for the corresponding consumer and services-focused companies at EM. A lot of these businesses are now rapidly shifting their business activity to digital channels. History tells us that technological change gets accelerated in times of crisis. If you look at the graph on the bottom right, you can see if you look at the composition of the EM universe, for instance, now versus 10, 15 years ago, it is very different, as it is now mainly made up of internet, technology, e-commerce type of businesses, very consumer focused, where clearly they are less sensitive to the vagaries of the global economic cycle and is ultimately being driven by domestic demand factors. So, in conclusion, there are clearly a lot of opportunities in these important growing sectors for those picking high quality stocks in emerging markets. I'm out of time, so I think I'll stop there. Thank you.
That's great. Thanks, Eric. And don't worry, we're good for time. We've built in a few extra minutes. Just before I hand over to Joyce, a question from me, actually. I mean, you talked a lot about Asia, but what about opportunities in the African continent? I mean, we've got, what, 50-odd countries there, and not much news coming out of there from a coronavirus perspective, other than South Africa, maybe. What do you think about opportunities from Africa?
Well, it's if you look at the numbers, so as of the end of March, there were just under 6,000 confirmed cases across of coronavirus in Africa, about 1,300 of those in South Africa. I mean, there can be no doubt that the stats are highly inaccurate, partly due to the very limited testing and most likely due to the fact that the true number of cases are being significantly underreported. We certainly expect these cases to escalate exponentially from here, and we are concerned about the potential for increased risk of the virus for people living with other medical conditions, particularly HIV. However, so far, there's very little data or evidence on the likely outcomes. The positive side of this is Africa has an extremely young population, and all the data so far suggests that young people are escaping the worst of the pandemic. 60% of Africans are below the age of 24, with only 4% over the age of 65, compared to Western Europe, which was 21%. So, we believe, and furthermore, due to the relative ineffectiveness of shutdowns, economic activity is likely to continue to move along to its normal place across the continent. A large proportion of the economic activity there is informal and or focused on basic needs such as food. So many of these activities will continue regardless of social distancing or even lockdowns. And finally, a quick point on South Africa. The rand depreciates significantly, as you saw in the graph. Equity markets are down, 36%, probably one of the worst performers in EM year to date. And we have been underweight SA for a number of reasons, but the country is starting to look more attractive, particularly banks, which are well priced, well managed, and well capitalized. So that's our current view on Africa at the moment.
Okay, that's very helpful. Thank you so much. So now let me hand over to Joyce. Joyce is up late. She's based in Hong Kong, so we're very pleased to have you. Over to you, Joyce.
Good afternoon, everyone, and thank you, James, for having me here. So let me introduce myself and my firm a little bit first. I'm the fixed income product specialist in GAFCAL, based in Hong Kong. And GAFCAL is an independent global investment research provider focusing mainly on macroeconomic research and asset allocation. We also advise a select range of funds and offer software solutions as well. We provide this type of service to over 800 institutional clients around the world, ranging from financial institutions, asset managers, to governments and central banks around the world. So first of all, let me first say that I agree very much with what Eric just said. There are a number of good reasons to stay long in emerging market equities. And me particularly, I'm interested in Asia because of a lot of positive fundamental drivers in here. However, what happened in the past 6 weeks showed the difficulty for being an emerging market investor. During this period, we had a perfect storm, actually more like a 3 simultaneous storm. The epidemic crisis is the one that's getting the most attention, but there are more. For example, the second crisis that the world faces is the concern over the solvency of the energy sectors and the oil sectors because of the collapse of the oil price. This also played a role in the third crisis, namely the US dollar liquidity crisis. Just think of it, a number of big oil state sovereign funds need to sell down their assets at a time when a lot of traders were at their home sitting in their pajama, probably not being able to really work too much. As these sell orders came in, and there's no market maker on the other side of the trading platform, it easily triggered a full-blown liquidity crisis where prices of a lot of different asset classes were all over the place. We can certainly feel it in Asia. I still remember there were one day that suddenly the morning was feeling very normal, but suddenly in the afternoon, all the bids in the bond market just disappear. And the thing is, actually, this type of thing happened not only in Asia or emerging markets. As you can see for the charts on the right-hand side, US municipal bonds, even AAA bonds sold off significantly in a few sections. Actually, US municipal fell around 14% in only 5 sections. Even the bid-ask spread for US Treasury was rather massively at one point. And all these are pretty unprecedented moves, especially since we are at a time when there's no big defaults or bankruptcy happening in the world. And in this environment, global investors did what they usually do, which is, first of all, pull out money from the emerging markets. As you can see from the chart on the left, the scope of the capital outflow from emerging markets was simply shocking. And this happened across emerging markets, even at the time when Asia has been ahead in terms of recovering from the virus crisis situation. And also Asia is supposed to be a beneficiary of oil price at $20 because of their net oil importer status. The Asian market also saw liquidity dry up extremely quickly. And because for the simple fact of this, that the capital outflow was massive back in mid-March, basically, even worse than the time in 2008. So imagine that even for an emerging market investor who are pretty conservative, they face significant challenge in the last few weeks. Let's say an investor, they have a portfolio in emerging market stock, but they're very well aware of the need of diversification, and hence they have a little bit of developed market equities. They have a bit of high quality emerging market investment grade bond. They have some AAA bonds. They have some US municipal to diversify their risk. But what happened in the last few weeks is they found that all the asset class, everything that they have are extremely highly correlated during the sell-off. And to be honest, it's not only this asset class, even gold, even US Treasury, which are supposed to be a hedge in a downturn. Even for them, they took a hit in the market. So during the peak, the crisis,
Joyce, can you just check your microphone? You seem to be cutting out a little bit.
March, basically all investors, not only emerging market, they found themselves impossible to sell anything without a hit. Is it okay now?
Yes, carry on.
Hello?
Carry on.
Is it okay? Okay.
Yes,
all
carry
right.
on, Jules.
So even for even for investor with a well diversified portfolio, what they found in the last few weeks is that they are taking a huge hit without any source of liquidity. But interestingly, what we find, and also increasingly more and more institutional investors find, is that against all expectation, Chinese government bond actually proved to be a very good safe haven. They are uncorrelated to US Treasury. They are uncorrelated to gold price. They are uncorrelated to global equities. And still, they deliver positive returns. So why? It's probably for a very simple reason. Very few foreigners own this market. And therefore, at a time when there is a margin call, no one has a position to sell, basically. I suppose that probably here on this call, no one probably own any Chinese government bond. But actually, this is a bond market that is very liquid and very deep. In fact, it is a US dollar 12 trillion bond market, which is the second largest bond market in the world now, surpassed Japan last year. As you can see in the chart on page 3, which is, I think, on the previous page.
I'm sorry, let's go back.
There are a number of reasons why one should hold some Chinese government bond in their portfolio. First of all, it provides diversification benefits. Second of all, is because it provides relative valued extra use versus other similar type of instrument in the market. And also, in addition, we are seeing a lot of capital inflow into this asset class. And the last is that's because China is very serious about doing renminbi internationalization. We are going to see more and more open up of the bond market to the world. So the next page shows you some of the charts indicating the diversification benefits of the bond market in China. So the chart on the left show you that the red bar basically show you the time when the equity markets was being sold off. And during this period of time, you should Chinese government bond always saw their yield gap down. Basically, it means the price go up. So at the time of a crisis, Chinese government bond did prove to be a very good diversifier. And the charts on the right show you the last 2 episodes, which is this year and also during the downturn in 2018, as you can see. Chinese government bond were the only one asset class that consistently delivered positive return. And these are all measured in US dollar terms in a downturn period. On the next page, you can see that having a fixed income position would be relevant also to emerging markets equity pickers. As you are aware, or as some of you may aware actually, a balanced portfolio in the US, what it means is that half in S&P 500, half in US Treasury, rebalanced quarterly. This type of portfolio did extremely well in the last 3 decades. It was because the US has been going through structural disinflationary boom period, where the bond markets usually are very good effective hedge for equity risk. And Asia has started this disinflationary boom in the past decade as well. And as you can see in the chart, a balanced portfolio half in emerging markets. I put it in Asia because that's what the market I like. Put half in emerging market Asia, put half in Chinese government bond, rebalance quarterly, you will get a equity-like return, but with much lower volatility. And we believe this type of portfolio will continue to work well in the coming decade because Asia is still in a structural disinflationary boom. From the assets allocated around the world. On the next page, it shows the extra yield that Chinese government bond provides. As you can see on in the chart, because China has been a lot more reserved in monetary easing, when all the other major bond market around the world are approaching zero or already below zero, Chinese government bond offer extra 200 to 300 basis point spread over its peers. And also, as you can see, the real yield is also a lot higher, even though it's negative in China compared to the rest of the world. it means that the Chinese authorities still have a lot more room to ease when needed, meaning more capital gain potential for the Chinese bond as well. Lastly, the last page. As I mentioned, China has been opening this bond market to the world, partly because of the renminbi internationalization reason, and because of the success in the last few years, major bond index around the world has started to include China into its benchmark, and therefore, with all this inclusion and with all the factors I mentioned earlier, we do expect around at least 800 billion US dollar inflow into this asset class in the next few years. So the bottom line here is that I think this turmoil provides a lot of opportunity in Asia, in emerging market. By having a diversifiers, especially ones that are very much underowned by the world, would really pay off in anyone's portfolio. I think I will conclude here.
Okay, Joyce, thank you so much. That was very insightful indeed into China specifically, obviously a hot topic at the moment. Just a reminder that we've got some questions coming through already, but if you do want to add a question, do type it in on the top right-hand panel, and I'll convey those to either Eric or Joyce. We've got a couple coming in already, so let me start with one here. This is actually for you, Joyce. You touched on this, I think. Someone's saying that the Chinese central bank seems to be restrained in monetary easing, and yet the Fed, the ECB, the Bank of Japan, and the Bank of England are all fully on board with balance sheet expansion. Is China behind the curve, and what are the implications for Chinese bonds?
China is indeed a lot more conservative in terms of its easing, but still, we saw that China has been doing drip easing throughout the last few weeks. Basically, they have cut reserve repo rates, they have reduced the required reserve requirement. Actually, just yesterday, they cut some of the policy rate as well. But the simple fact is that they're not going to repeat what they have done in 2009, because they do realize that a measure like that will run the risk of overheating the economy. And in the last 3 years, China has been actually put a lot of effort in terms of financial de-risking, and they just started to see some results, and therefore they are not going to abandon this de-risking dynamics drive unless it's really necessary. And also another thing is that they view this situation, the virus situation, being temporary. As Eric also has mentioned, we are already seeing that more and more activities are recovering. And therefore, I think Chinese authority is seeing that they want to be more reactive and more data-driven in terms of easing. But still, we do expect that the easing cycle in China is going to be continuous, especially since now that we know that the export growth in China is going to slow down quite significantly because of the lockdown around the world. And therefore, we do expect China to respond with more interest rate cuts, and also the nominal growth rate in China will be continue to slow, but in a more manageable manner. And also inflation will not be a concern. And all this putting together will be a pretty favorable environment for bond investors.
Okay, thanks. Eric, this looks like a question for you, I think. It's someone's asking, you mentioned a way to maximize the opportunities in emerging markets is by being overweight in countries that offer a more favorable environment. Which are those at the moment?
Well, at the moment, we tend to favor East Asian markets of Taiwan, South Korea, alongside Russia and Brazil. Interestingly, for those of you that read David Stevenson's column in the Financial Times, you will have seen that he made direct reference to our country picks at Milltrust in yesterday's edition. He managed to read through one of our latest geographical asset allocation reports, and thankfully he agreed with our views. But Russia remains the top-ranked country in our model. It has the double benefit of offering attractive valuations and high dividends. The year-on-year price momentum is actually still positive. A quick side note on Russia, because I did mention the different buckets, and Russia is a commodity exporter, and it will suffer from the fall in oil price, but the country is very self-sufficient and better prepared than others to deal with this crisis. It has a freely floated currency, which will help protect the economy. Much of the pressure will probably be taken by the currency depreciation, with limited influence on inflation. So, as most consumer goods are already produced, domestically produced. South Korea, as I mentioned, is another overweight. They've been quite resilient from a growth perspective. It also has an inexpensive equity market and an undervalued real effective exchange rate. Meanwhile, Taiwan's attractiveness is boosted by their favorable risk indicators, including substantial current account surpluses relative to GDP. And finally, Brazil is fairly priced, significant undervalued exchange rates. So those are our top picks and what we are overweight in our portfolio at the moment.
Okay, great. Here's an interesting question. I'll put it back to you first, Eric, and then we'll come to Joyce. So someone's saying, at what point does an emerging market become a developing or developed market?
Well, I did make reference in the presentation, and in terms of, I think it's more a case of how you define developed versus emerging markets. I made the case that maybe these markets should be judged by how they respond to crises and how they protect their citizens. So it's really in the in how you define it. You look at South Korea, for instance. In the FTSE, it's a developed market, where the MSCI is still an emerging market. So it's a constantly evolving. To the same extent, you could look at frontier markets graduating to emerging. So historically, it's been the wealth level, but I think it goes deeper than that. So certainly an ongoing topic of discussion.
Yeah, interesting. Joyce, what about you? Any thoughts on that? Hello, Joyce?
Yes. Is it okay now?
Yes, that's fine. That's fine.
All right. Historically speaking, I would say that emerging markets, they're always a kind of a middle income trap for emerging markets, and the only one that are being able to get out of it are usually the one that who have been following industrial policy development model. And I think China has been coming through a long way in this model, and the likelihood for it to break through this middle income trap problem is the likelihood of it is quite high, and therefore I think it's just I would say that maybe in a few years, China will be able to move on to more like a developed market status, especially now with it opening up its capital market to the world.
Yeah, okay, thank you. Here's, I think people are looking for investment tips now. You've got people thinking, both of you. I think this one's for you, Eric. What markets do you like? What's a top pick and why?
The markets. Well, I think I gave my top picks. We like Taiwan, South Korea, Russia. Those are big overweights for us. Brazil. I didn't talk a lot about Brazil, so maybe I'll expand on that. Brazil's economy. I mean, first of all, you look at the Bolsonaro and his view that the virus is perhaps similar to Trump. So the way they're managing the virus isn't probably the best example. But the economy still has a lot of room to grow. It has a big unemployment buffer, all-time low interest rates. So there's a lot of positives from a country perspective. What we're buying in Brazil, and we bought a lot of Brazil the last few weeks because of the markets have come down significantly, are the micro stories. We built exposure to retailers who have strong balance sheets, who successfully transitioned to online from bricks and mortar. In many cases, businesses are attracting a new profile of clients that it didn't reach before the crisis, and we're seeing that everywhere across all sectors. Another business sector that we like is in the education sector. A lot of these schools are moving from offline to online. And this business in particular has a great primary and secondary school program, which is now being implemented across a lot of these families and school systems. So there's a lot to like in these countries, and those will probably be our top picks.
Okay, that's great. And I think we've got time maybe just for one more question. This one's definitely for you, Joyce. Someone's asking, what do you look at to assess the financial health of the Chinese financial system? The financial media has been talking about China's Minsky moment for over a decade, but it has failed to play out so far. So is it a legitimate concern, or is it a matter of time?
I actually, in the past almost a decade, for every meetings that I go to, with clients, we spend at least half, if not 2/3 of the meeting talking about this means key moment discussion. And indeed, Chinese financial system does have pocket of weaknesses, and the regulator actually are very well aware of this. And therefore, since February 2017, they have officially launched a financial de-risking campaign. Basically, they squeeze out all the speculative credit in the markets. They force the banks to move all the off-balance sheet item back to on-balance sheets. They have closed a lot of regulatory loophole in the system. They remove all the government guarantee kind of implicit promise for the local government bond debts as well, and all this play out quite well in the markets. And credit differentiation is starting to slowly happen in the onshore bond market as well. And the thing that I look at is that as long as the Chinese total credits relative to the total deposits in the system are relatively low, in a sense that the deposits fully cover the credit in the system, is still a quite healthy system. And for China, it is indeed the case. Actually, for example, before the global financial crisis in the US, the total credit relative to deposits is over 400%. And that was one of the reasons why it forced the deleveraging in the US back then. And right now in China, the total credit is still fully supported by the deposits. So as long as China has a full commitment to avoid overheating in the economy, with a strong deposit base, with a effective capital account control, with a kind of positive net foreign assets position, China would be able to avoid any systematic risk right now. So, but in the future, the one thing to look at, to keep track of, it will be the total credit relative to the deposit in the system, I would say.
Okay, thanks very much. Well, I think we're very nearly out of time. There are, I note, a number of questions that we weren't able to get to. So if it's all right with you, Eric and Joyce, what I'll do is I'll speak to those people and see if we can put you in touch by email and help to answer those people's questions directly, because we've got probably half a dozen that we didn't get to. So very popular speakers. Thank you so much. So from our perspective, thank you, everyone. Thank you to Eric and thank you to Joyce for your very insightful talks. And there's just a reminder of the forthcoming webinars on the screen there. And if you were to go to the FS Club website, you can see how to subscribe to our daily email, and that will prompt you to request the customized bulletins that I talked about earlier on. So again, thank you to everyone. Thanks for joining us. The recording will be available on the website very shortly, and we look forward to seeing you at our future events and hearing you in webinars. Thank you.